good day, traders, and it's that time of week again where we're looking at the week that was, the month that was. We're having a look at all the event risk that's going to come up so we can really get a good holistic perspective on our risk reward profile. We'll have a look at positioning in market. We'll have a look at risk reversals, which is the skew of call to put volatility using 25 deltas. And we'll also have a look at implied volatility in the market, which is giving us a sense, not just of what I think, which is not really that important, but what the market thinks about the event risk that's coming through and whether that's going to cause big outside moves with a 68.2% level of confidence. But let's go straight into the boards. And actually, let's take a step back because it's the new month. We're starting in the start of November and have a look at how October fared. And you can see here from the Bloomberg charts that the best performer has been the British pound throughout October, up 5.2% against the US dollar. We saw some really good gains in some of the EM currencies. The Korean won, which has been one of my favourite sort of sentiment indicators, had a really strong gain of about 3.1% against the greenback. The Mexican and Brazil, some very strong gains there. And we saw the re-emergence and a position adjustment in the euro, which was up 2%. So, some big moves, and most currencies in the major currencies up against the US dollar throughout that period there. And I thought, obviously, the fact that we've seen the S&P pushing to new all-time highs means we've seen a little bit of that safe haven unwind coming through in the US dollar as well. Norwegian krone being the worst performer in G10, and also the Japanese yen, again another function of what we've been seeing there. Now let's actually have a look at what happened over the last 5 days again, just to give us a bit of perspective playing through. And you can see that the Aussie dollar's actually done quite well over the last 5 days. Everyone looking at this phase one deal, obviously that's not going to take place in Chile anymore, but there is talk that could potentially take place. And that summit could take place in China. Are we going to get a full ratification of that phase one deal? Obviously, the market is interested to see there. The Chinese news flows overnight suggesting that may take time. Then actually coming out of a long-term trade deal may be tough to do. We saw a little bit of selling coming through in the Aussie dollar on the back of that. But ultimately, over the last 5 days, you can see the Australian dollar up 1.1%. People are seeing signs that the will is there to look at this phase one trade deal. Whether phase two goes through at any stage is something we'll be watching. And of course, we've seen the Fed meeting coming through. They're obviously a big change there in the rhetoric, where we've seen them changing from acting as appropriate to one which is assessing the appropriate policy path. The market obviously very interested to understand that they are completely data dependent now. And we'll talk a little about my Fed model going forward in that situation. We've seen the Bank of Japan meeting, a little bit of disappointment there, some strength coming through in the yen. But ultimately, over the week, over the last 5 days, the Korean won, again, up the top of the pile. Really interesting there. Again, one of my favourite G10, or so one of my favourite FX sentiment indicators there. And British pound continuing to price out that risk of no deal. And then we're focused very much on the polls now, where the Tories have got a reasonably firm lead there. Whether that comes to fruition under the first past the post rule is yet to be seen, of course, but I'd be still treating these polls with an air of cynicism, given what we've been seeing in 2015, 2017. But again, the pound continues to be repriced on that position adjustment, on the idea that no deal Brexit has been coming out of the market, has been for some time there as well. So just give you a bit of perspective of how G10 currencies have fared versus the US dollar over the last 5 days there. You can see the Aussie dollar looking pretty good. Actually, if you look at the Aussie dollar on the daily chart, you can see we've gone up to test the 2018 downtrend. In fact, if you draw a regression from this bear move that we've been seeing, we traded up 2 standard deviations to that line of best fit, and we've seen sellers coming through. So is this the place now to start fading Aussie dollars? Well, I think that's going to be interesting, as next week we do have the Reserve Bank of Australia meeting. We've got retail sales, and also we've got statement of monetary policy from the Reserve Bank. Will that actually cause some downside moves in the Aussie dollar? Yeah, we will have to be seen. I think it's probably worth going straight into my interest rate model, just to give us a sense about how we're positioned in terms of rates and what the market is expecting on that rate structure for the week ahead. And as you can see, on the third from right column, you can see the implied probability of a rate cut or a rate hike at the next meeting, but these are all suggesting that we're getting rate cuts. You can see at the next meeting on December 12th, the ECB, there's about a 9% chance that Christine Lagarde's going to come in under the helm at the ECB and cut rates. There's about a 10% chance there. The Fed meeting, well, the next one comes up on the 11th of December for us here in Australia, and the market now is suggesting that there's a 27% chance we get another cut there. Of course, we're data dependent, and I am recording this video prior to the ISM manufacturing numbers. We've got Richard Clarida to speak, and also non-farm payrolls numbers, although those non-farm numbers will be somewhat watered down by what we've been seeing from the GM strike as well. So we're expecting a pretty low number there. The market might give that a bit of a low berth. But the idea that we've seen a fairly low number in the Chinese manufacturing numbers. The Chicago PMI number, which is a very volatile series, has lowered expectations ahead of tonight's ISM numbers. But if that comes out weak and we don't get a real clarity around the trade situation, then markets will continue to price in rate cuts going forward. In fact, on the far right column, you can see the number of basis points, the cuts that are being priced in over the coming 12 months. This is really key now. So you can see that we've got 61 basis points, so just over 2 rate cuts still being priced into the swaps market over a 12-month period. So the market is saying, yeah, look, fine, you can be data dependent, but we think that data is going to deteriorate somewhat going forward. Bank of Canada, well, we've got a 1 in 3 chance that we get a rate cut coming through at their next meeting on the 4th of December. But go to the RBA. So I talked about we've got the RBA meeting this coming week. There's only a 6% chance that we're going to get a rate cut. So obviously we're not going to get a rate cut from the Reserve Bank. There's about a 30-odd or 20% chance that we get a rate cut in December. But go out there on the swaps curve, we've got 18 basis points being priced in. So just under 1 rate cut being priced in over the coming 12 months. That's a new development over the week that we've seen the market pricing out there. The argument, of course, is the idea of diminishing returns from rate cuts here in Australia. Do we need to see unconventional policy being ramped up? There's been a lot of talk in the media about that, but I see that more as a situation where the media are educating the public about what's happening around unconventional monetary policy settings, such as quantitative easing. The RBNZ, they meet on the 13th of November. There's a 61% chance that they cut rates at that meeting. So for people who want to have a bit of that transparency about what's being priced into rates markets at the moment for your currency exposure, I think that's definitely something we're watching there as well. Now have a look at the setups that we're seeing in euro dollar. That's an interesting one as well. We break through obviously that downtrend, the August downtrend at 110, back on October the 11th. The number we're looking up to the top side if you're a euro bull is 111.79. That's the 21st of October high. If we get a breakthrough there, obviously you're looking at that 200-day moving average around 111.97. You get through there, I think you probably on euro dollar you're talking about getting into that sort of 113, 114 range. Cable as well, obviously we're focused on what's happening in the polls. I don't see any change in the trend in the polls against the Tories anytime soon. Obviously the worst case for me is that we do get a hung parliament anytime soon, but for me we're looking at those polls. I think that's what the pound's going to be trading off. We're not talking so much about Brexit anymore. The politics has been well defined, but we're watching the polls, and I think if you get a break of 130.13, which again is the 21st of October high in cable, then again you can make a little bit higher. But it's a tough gig trading the pound at the moment when you're trading really against the polls, and those polls have been consistent in front of a majority for the Tory party for a couple of weeks now. In terms of US data, what are we watching this week? As I say, we're saying this prior to the ISM manufacturing, Richard Clarida, his speech, and also what's been happening in non-farm payrolls numbers. But for me, we're having a look at durable goods. We're going to have services ISM numbers. That's going to improve a little bit in the eyes of the market. And we've got University of Michigan 5 to 10 year inflation expectations as part of the confidence survey there as well. So a little bit of tier 2 data. The market's not going to be overly influenced by that situation. In the UK, not a lot that I'm really focused on. It's again coming to focus on what's happening in the polls. In Europe, you've got PMI numbers playing through. That could be quite influential. You've got in Canada the jobs numbers there, although there's no real poll playing through. And again, the Bank of Canada were a little bit more dovish on the outlook there as well. One thing that we did look at is one from the Bank of Canada statement is the outlook for global sentiment. As you can see here from the Global Policy Index that comes through from this third-party Baker, you can see that that's started to roll over. They specifically looked at the 3-month average there, and that started to roll over a little bit, which is one thing that they looked at. We saw that uncertainty index really creeping up, and I think that's part of the reason why they were more dovish than what the market was looking for. But now, how does all that play out into the volatility structure? Well, as you can see here from the volatility chart, on the left-hand side, we've got the realised volatility. This is statistically happened. This actually happened. We've looked at the average true range, 5-day ATR. That's what a lot of clients will look at. A lot of people will set their stop loss and how much risk they're taking based on ATR. We also got Bollinger Band, which obviously a reflection of where prices are moving from that 20-day moving average. And you can see that they've tightened up a little bit. So realised volatility has come down over the last week or two. You can have a look at 1 week at the money implied volatility in sort of that middle column there under the implied volatility structure. Dollar Turkey, we've had a few clients suggesting that they want to see that. But again, you know, at 14.6%, that's an annualized number. We're breaking that down into the weekly. To give you context, that's the 12th percentile. So it's still pretty low, even though it's obviously the highest out of these currencies that we've been quoting. 12th percentile shows that this is pretty low. Going to Aussie yen, you know, it's the second highest, that's 18th percentile. The sterling crosses, the implied volatility has come right down. So, you know, after a period of very, very high expected moves in cable and sterling crosses, the implied volatility has come right down. So implied volatility in FX markets, as you can see across the board now, very, very low. That means for me, you know, we'd be looking at having tighter stops. We can afford ourselves tighter stops, which you can see here from the implied move. I've used straddle pricing to give me the expected move in the market. I prefer to use this rather than the ATR, which you can see from the left-hand side. But again, you know, you're looking at what's happening there, and then the implied move using a 68.2% level of confidence. This is what the market's expecting. They're saying this is the kind of levels we're looking. If you look at Aussie dollar, for example, even though we've got the RBA meeting, they're saying that there's probably likely to be a 67-point move on the week, no more. We're looking for a range of something like 86, so 86, 85 down to 85, 51, something to focus on there as well. Now, if you have a look at the risk reversal market now, just to give you a sense of how sentiments, and I played this off against the Commitment of Traders report. That Commitment of Traders report will be updated overnight. But if you have a look at Aussie dollar 1 week risk reversals, this is the skew of call volatility relative to put volatility. When you get a negative number there, like you can see in Aussie dollar, negative 0.37, you're saying that put volatility, the right to sell the option on 25 deltas, which is a 25% chance of being in the money under that expiry, they're saying that there's a slightly negative skew there. So people have been beggar buyers. There's been more demand for put volatility over call volatility. But at the same time, when we look at that skew, which is where we put the context around this, we can see that that number is actually up at the 75th percentile. So whilst it's negative, generally what we see is people paying up for put volatility over call. This is actually at the upper echelons of that range that we've been seeing over the last 12 months. So a much more neutral structure. If you have a look at positioning, it's come back a little bit, but if you look at the Aussie dollar, the technicals are looking somewhat more favourable. But in terms of the option markets, what we can see here is that people have been relatively better buyers of call volatility over put volatility, a much more neutral setting. So not a lot to work with this coming week. Implied volatility's come down. We're not expecting those big moves. Obviously, equity markets still at record highs. That's obviously positive for things like the Korean won, Aussie yen, for example. But we're also seeing a much more neutral situation in risk reversal, something to watch as we go along. So definitely, you know, some opportunities coming through in markets. We're looking at some big levels, but volatility has come right down, and we're very much into a data-dependent situation.